All right, I'm here with David Hall from 10 Hats Accounting. Thanks for coming, David.
Thanks for having me, Josh.
David, I know you're an SMSF auditor and a small, medium business accountant.
That's correct.
Tell us a bit of what's your origin story?
My origin story, I've been in accounting for small business and SMSFs for about 40 years now.
40 years.
I know,
wow.
It doesn't look it, does it?
Yeah, no.
And I enjoy working with business owners to become successful, because I believe that when we have a strong, successful small business community, it makes our overall community much stronger and successful.
Yeah, definitely. And our business owners like making profits, so
Absolutely.
the more they make, the better. I want to talk to you first just on the SMSF auditing side of things, because there's not as many auditors around anymore, as the conglomerates have taken over and bought a lot of these things. And I've got some key questions here just around SMSFs, and I'd like to get your input on what, from the auditor's point of view, and maybe we can get some war stories too. So first of all, I just want to see what the primary responsibilities of trustees when managing a self-managed super fund.
Okay, so the trustees have a statutory responsibility under Section 17 of the Superannuation Industry Supervision Act. They must operate the fund solely for the provision of retirement benefits plus a couple of other things. And they must also comply with all of the provisions of the Superannuation Industry Supervision Act. That act applies no matter whether you have a big industry fund or a big commercial fund or a self-managed fund. It's the same rules.
Yeah, and I think a lot of people just think about, because it's the SMSF and it is their own money, that they can do what they want with it, and that's definitely not the case for the self-managed super fund. It has to be run specifically and for that obviously sole purpose. That
Absolutely, it's their money, but not yet.
Yeah. And I suppose this is the reason that superannuation was brought in, or was created, for that retirement benefits, and to make sure that people aren't accessing their money sooner than what they should be. Make sure they're doing the right thing, obviously, definitely around which I see on the investment side of things, that maybe people aren't doing or considering that, it's their retirement and that money's for their retirement, not to get access earlier.
Absolutely.
So just leading into that, so what are some of the common compliance issues that those trustees should watch out for?
The biggest thing that they have to watch out for is withdrawal of benefits before they're entitled to them. And we saw some of this happening during COVID. People were short on money, and so therefore they were taking it out of their super fund, which of course is a big no-no. The second one that I come across often is not dealing with related entities at arm's length. Yeah. So if your super fund owns a property and you're renting it from the super fund, you have to act like you're an arm's length landlord and enforce the terms of the lease. And the third compliance issue that often comes up is the actual valuation of the assets in the fund, and this often applies to investments in property. Yeah, definitely. That
SMSF investment strategy was obviously a key focus for them a few years ago, with making sure that people are considering stuff correctly, make sure they're considering insurances as well, and definitely around those funds that have been set up to purchase a property with, maybe they don't have as much money, $100,000 or something like that, and the primary asset is that property. They just run into cash flow issues, which I've seen a few come back to me that have ended up having to be folded because they've run out of funds with the
Absolutely.
repayments.
The requirements of the investment strategy are they must consider risk, diversity, cash flow, insurance, and if you have a sole asset, a single asset in the fund, then you run into the question of whether you've actually complied with those things. Yeah. And of course you also need to remember that if a member dies, that member's balance has to be paid out in most circumstances. And if you've only got a property in it, you may have to sell the property at a bad time in order to pay the death benefit.
Yeah, that's a really big one for me. I mean, regardless of kind of what the situation of the person is in, if they are coming for advice for a self-managed super fund and they're doing a limited recourse borrowing arrangement to purchase a property, we would always include some insurance cover in that fund, just in case something happens to them. At least the fund's got cash flow. We've got some cash that money can be distributed to the individual. If they've passed away, then their super contributions are going to stop. So that can really put in jeopardy the cash flows on
Absolutely.
that fund. I have seen a few times that people have kind of bought holiday homes and stuff like that. So I'm guessing you've seen a lot of those things that have happened.
It's crazy what some people put in their super funds, yeah.
I've seen a few that have artwork and things like that in there, which obviously creates some other...
It comes down to, well, there's a couple of things there. One is the question of valuation of artwork, but the second is that falls within a special category called collectibles, and you're not allowed to have a collectible at your home where you're enjoying the benefit of it. Yeah. I've seen all sorts of things in super funds, including mammoth tusks.
Yeah. Yeah, okay.
Try valuing that.
Yeah, awesome. That's an interesting one. Yeah, well, I remember one that I had a while ago that was a commercial premises that they run the business from, and then they had artwork that they were displaying in that business as well in the self-managed super fund. So I don't think that would have met the rules at all.
Absolutely not.
But yeah, these people try to get away with anything with accessing those monies. The problem is being obviously you just get, if something does go wrong or you do get caught with this, because the SMSF has to do the audit each year, that the penalties can be quite steep for breaches.
Absolutely. Look, the tax office has taken a very lenient approach up until now. They would prefer to see, if there is a breach, they would prefer to see that the breach has been fixed before they apply any penalties. So if you are in the situation where your auditor discovers a breach, you need to fix it, work with your accountant and your financial planner, fix the breach, and then it can be reported to the tax office that's the case. The worst case scenario, the nuclear scenario, is that the commissioner can make your fund non-complying, and that is a last resort for the worst funds. If your fund is non-complying, two things happen. Firstly, you no longer have the benefit of the 15% tax rate. Your super fund is taxed at 47%.
Yeah.
That's the first thing.
Yeah.
The second thing, which is worse, is the commissioner can take 47% of the fund's assets.
Yeah, okay. Yeah, massive. And if it's non-complying, then obviously that throws up issues with getting contributions and things like that. I've come across a few that have been non-complying, and these people have tried to get loans and stuff like that.
Absolutely,
They've got no hope of doing it. So it's usually the ones, I think, with people that are not using a professional advisor to manage it, that it kind of gets, with the rules, they are complicated.
Yes.
There is a lot into it that it gets away from them. I've seen ones before where they've set up ComSec accounts to do share trading, but the ComSec account has been in their own name, and then they've transferred money from the super fund and bought shares in there. And I've seen it that it's run for a number of years. Even their existing accountant hadn't picked it up and things like that, because they never looked at that infinite detail or thought the person had done it right initially. And obviously the issues that comes up. I'm just getting off topic a little bit there with... you mentioned about the unlisted assets, about the property and valuing those, because that's been a big theme lately with the industry super funds, with all their unlisted investments, and those have been in the AFR and in the press quite a bit with how they value those assets and some of the reserves or things that they can do with those valuations if they take, because of those big range. So definitely I can see how that would, on a smaller scale with a self-managed super fund, could throw up some issues.
Look, the valuation is important, because it's in the legislation. You must value it. The Commissioner of Taxation has issued guidelines on what he expects a valuation to be, and the big thing is it needs to be supported by objective and supportable data. It can't be an opinion. So the minute I get a valuation that says, in my opinion, it's not acceptable as audit evidence, the reason why the valuation is important is because the value of the fund determines a number of things. For example, the minimum pension that needs to be drawn each year, or the total super balance, or a number of other tax-related issues.
Especially if you've got on the SMSF, if it's just a single person or husband and wife, potentially the values are not as big an issue between those. But if you started to add children and other things like that, if the asset's not valued correctly, then you could see some members, maybe their balance is not, maybe they're getting shortchanged, or maybe they're getting too much money if the parents have overvalued the assets and they're drawing down pension. They're getting more out of it when maybe the asset's not worth that much, and that's really obviously on a lot bigger scale of the industry funds, that the issues that they're coming into. So let's go back to this. So on that, we spoke about that investment strategy. So how can the SMSF trustees just ensure that they're meeting those obligations?
Look, the most important thing is to work with your professional advisors, okay, your super fund administrator and your financial planner, because those guys should be across the legislative requirements and will help you to sit there and review all of your records each year and make sure that you're complying. Certainly your investment strategy needs a regular review. It's not a case of, let's do one when the fund gets set up and then forget about it, because things change. We often come across investment strategies that haven't been updated because they were created for a single property, and then the property gets sold, and they haven't updated the investment strategy. So it's really important to make sure your professional advisors are across the circumstances of the fund and make sure that things are still complying. Yeah,
and I think some people I've seen before, the people they kind of half do it, or they a bit blasé with it. I always say to them, like, if you're running like a super fund. If your big name super fund was running the investment strategy that way, or just blasé, like you wouldn't be investing in there.
Absolutely.
And that's the kind of rules that they need to follow as well. So tax implications of self-managed super funds. So how can the trustees optimise their tax benefits? Probably number one, making sure it is compliant so they don't get taxed more.
Absolutely. Look, not so much the auditor's area, looking more at the compliance with the SIS rules, but certainly on a general statement, look, you can develop with your financial planner a particular strategy of contributions and pensions, taking lump sums out, recontributing as contributions and so on. Those are some of the benefits of being able to have an SMSF instead of being in a bigger fund.
Yeah, I think with the bigger funds as well, obviously once a contribution goes in, they take the tax out straight away, whereas in a self-managed super fund, the tax is done at the end of the year, so you potentially had more invested for the year.
Cash flow.
And depending on the assets, there can be some additional tax benefits with franking credits and things like that.
Absolutely. We see a lot of funds investing in shares, and once they go into pension mode, the fund pays no further tax, and therefore the franking credits become refundable.
Yeah, excellent. All right, so last question here. What steps should be taken to prepare the self-managed super fund audit, and how should audits be conducted?
Well, the most important thing is that have your paperwork together, because the auditor will always ask for certain things. Things like bank statements, things like valuations of property. The valuations are the favourite topic of the ATO at the moment, and they want to see that things have been valued around the 30th of June by an arm's length process. And the audit needs to be completed before the tax return is lodged. Generally, the tax return is due on the 15th of May. Please do not leave getting the audit done until the 1st of May.
Yeah, unfortunately it's not uncommon to see these tax returns for self-managed super funds not done for a couple of years after, which is really disappointing, and that ends up falling into non-compliance. I'd probably just add to that around the trust deeds and stuff like that, making sure those are all dated and signed correctly, and make sure everything's in there and those are stored securely. You've got backup copies, you've got soft copies there ready to go to send out. I've seen ones before that trust deeds aren't even signed, and it's been running for 5 years and it just hasn't been picked up.
That's a really great question, Josh, because we are now getting to the point where super funds have been running for 20 or more years, and we're starting to see generational change happening. And what's happening is that once the original members have died, the new members or the beneficiaries are now starting to dispute some of the terms. And it lives or dies by the paperwork that can be submitted to the court.
And I suppose that trust deed, obviously, that needs to be updated as well. So do you want to share some thoughts on that, when that trust deed should be updated? Key changes with legislation, things like that?
The relationship between the legislation and the trust deed is that the legislation will set the broad principles of how a super fund should be run. The trust deed provides the detail. So things like what it can be invested in and so on. Therefore, the trust deed must be updated each time there's a significant change in legislation. The last major change we saw in legislation was, so if you have a trust deed that's dated before that date, you really need to look at it and see whether it allows you to do things that comply with the legislation.
Yeah, definitely. Excellent. Thanks, David, for your time. I'm sure if anyone needs to get in touch or wants to have a chat with you, that they'll reach out at 10 Hats Accounting.
Absolutely. They can check our website, www.10hats.com.au.
Excellent. Thank you.